Hi there, welcome to The Close. I'm Lindsay Biscaya in for Morella. Today, markets are closing in half an hour from now. So first, let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. China will begin halting tariffs on some Canadian agricultural products starting next week. Beijing will suspend tariffs on Canadian canola meal and pea imports, as well as lobster and crab imports. Now, the move comes after Prime Minister Mark Carney's visit to China last month and is in exchange for Canada cutting tariffs on Chinese EVs. Laurentian Bank of Canada posted first quarter results that came in below expectations. The Montreal-based lender missed on profit and also reported a net loss of just over $20 million. Laurentian says the quarter was hit by costs related to its strategic shift. The lender is transitioning to become a specialty commercial bank and exit retail and small banking. The CEO says the performance reflects a pivotal step in the bank's ongoing transformation. And we are tracking shares of Warner Brothers, Netflix, and Paramount today. Netflix has officially backed out of its bid to acquire Warner Brothers. The move follows Paramount raising its offer to $31 US a share, a proposal Warner's board has now declared superior. Netflix says the nearly $111 billion deal is no longer financially attractive. Netflix has confirmed that Paramount has paid the $2.8 billion termination fee on behalf of Warner Brothers. And we'll take a look at the markets now. The TSX is trending down at the moment, down by 0.4%, still above 34,000 points, though. If we take a look at U.S. markets today, trading down to end the week, you can see the S&P 500 down by 0.5%, Dow Jones down by more than a percentage point, and the NASDAQ down by a percentage point. Investors seem to be having some fears over AI today, and we can see that sell-off happening in real time right now. Statistics Canada reports that the economy ended a volatile year with a contraction in the final quarter of 2025, primarily due to businesses reducing their inventories. However, our next guest highlights that the slowdown in business investment is a particularly concerning development. Let's welcome Pedro Antunes, Chief Economist at the Conference Board of Canada. It's good to have you join us. Thanks so much.
Oh, well, it's a pleasure. Thanks for having me.
So let's start on that note then. Why is that so concerning to you?
Well, I think investment plays into the whole story around productivity and our productive capacity. Private investment in particular, if we're looking at non-residential, so anything but housing, think of structures, think of intellectual property or machinery and equipment. These are the things that add to essentially our productive capacity, our productivity, if you'd like, as well, but also tend to create future jobs. So we're seeing, because of all the uncertainty and the aspects related to access to the U.S. market, I think we're seeing essentially businesses sitting on their hands here with respect to investing in that capital.
And when it comes to businesses reducing their inventories, are companies trying to lower their holding costs? Or are they preparing for decreased demand, or is it a little bit of both?
Well, actually, I think that's the one little bit of good news in the accounts that we got today. We've been seeing this kind of buildup in inventory. So you can imagine, for example, if you're a wholesaler or a retailer, and if all of a sudden you have consumers aren't showing up at your door, you've brought in all this inventory, you're not able to get rid of it. That's a concern. And we've been seeing a buildup in inventory for a few years now, with some concern about when we were going to see that kind of come down. And in the last quarter, in fact, and with the revisions through the year, Statistics Canada has told us now that, in fact, inventories have come down. So that takes away from economic growth, but it suggests perhaps that, essentially demand for some of that has been a little bit better than expected from a wholesale or retail perspective. And that might mean they're going to place more orders in the future. So that's the one bit around business investment, because inventories are part of that big investment pie that is a little bit of good news here.
Interesting. When it comes to business investment, it also declined, though, due to weakness in residential activity. So can you explain that, and also what factors played into that?
Yeah, well, I think, the residential I mean, it's essentially the existing housing market has been depressed for quite some time now. We're seeing key markets, especially in Toronto and Vancouver and others, really essentially prices softening and essentially sales activity slow. So it's not surprising that we're seeing residential investment overall, both in terms of new housing, but also in terms of the financial, how should I say, the financial activity with sales that adds to that part of the economy. So and I think part of that, of course, is the demography. We've seen a slowdown in demographic growth. We've actually had negative population growth now because of what were the new policies around non-permanent residents and immigration in general.
I'm not sure if that plays into consumer health as well. Like, what do you read out of this report that indicates what level we're at when it comes to consumer health?
Yeah, well, consumers, I mean, that certainly doesn't play in overall consumer spending. But when we look at the accounts, we did see some weakness in consumer spending. Let's not forget, too, that consumers were kind of the pillar of economic growth through that weak period in the first half of the year when exports were failing. And now in the third quarter, we had weakness in consumer spending, but now that's kind of rebounded a little bit. So there is a little bit of good news there. I still worry about how sustainable that is, given that a lot of consumers, a lot of households are still turning over or renewing mortgage debt that they took on in 21 and 22 with very low mortgages. And now that strain of higher debt financing costs is still affecting consumers. We know that. But yet, in the fourth quarter, at least, they held together fairly well. So that was a little bit of good news there as well.
Okay, so some good news coming out of this report, it sounds like, or some reasons to be slightly optimistic. When it comes to this environment that we're kind of in right now, we've been seeing this low fire, low hire environment. Do you expect that to continue?
Yeah, and unfortunately, I mean, while we did see a few good indicators in the last couple of quarters, when we look ahead, if we don't get some sort of resolution here with respect to our trade with the U.S., I think this is going to be more of the same. And the weakness going into 2026, I mean, there's not a lot of job creation as we enter this year. So last year, in fact, at the end of 2024, we still had quite a bit of with the economy had started on a strong footing. When we look at what's transpired through all of 2025, has been quite weak. And of course, in the last quarter, we've got a negative. So I don't think there's a lot of good news for this year unless we get some sort of trade deal worked out with the U.S. That's really critical to getting things back on their feet.
And that's where I want to end things. Like, I'm kind of asking you to predict the future, but just in terms of how you see things going, how do you think those renegotiations will go? Do you think we're still going to see, tariffs coming from the U.S. for the remainder of this year?
Well, it's a big question mark how long this lasts. I do believe that, as we've seen it time and time again, that there's a lot more threat and a lot more bark, if you'd like, than bite with respect to tariffs. Both in President Trump's first administration in 2016, we did eventually get NAFTA renewed as CUSMA, our new trade deal that we're working with. This time around, it's been a similar story. I know there's a few sectors that have been very, very hard hit, but generally speaking, we still have most of our goods traveling tariff-free. We just need to get some certainty, because what's holding back business investment is that uncertainty. They don't know what's coming, and they're not willing to put investment into place or hire if they don't know what the future holds. So it's the uncertainty really that's hitting us here.
Okay, we'll leave it there. Pedro Antunes, Chief Economist at the Conference Board of Canada. I appreciate your time and your insight as always. Thank you.
Thank you.
North American stocks pulled back today, so we'll have more on what's driving market jitters when we come back. Stay with us. Welcome back. Our next guest says the value rotation has plenty of room to run and thinks emerging markets are in for another strong year of performance. So let's welcome Jordan Jackson, Global Market Strategist at JP Morgan Asset Management. It's good to have you join us. Thanks so much.
Thanks so much for having me.
So what we've been seeing so far this year is kind of like a shift from growth stocks over to value stocks. Do you expect that trend to continue throughout the year?
We do think that this is very much a sustainable trend, and arguably this rotation really began in November of last year. The tech sector last peaked out on October 29th, and so when you just look at that 4-month period, values actually outperform growth, looking at the Russell 1000 value and the Russell 1000 growth indices by 18 percentage points. If you go back to 2000, that is the top 2% of rolling 4-year windows where we've seen this type of outperformance. And a lot of it is a bit of AI fatigue. We know valuations we're getting a bit stretched across the AI and the large cap growth trade. When you think about interest rates, our view for the Fed is that rates the Fed's probably going to cut rates 1 to 2 times. So you think about the cost of capital, it's still quite high, and that disproportionately impacts more expensive growth stocks whose cash flows are far out into the future. And then lastly, you've actually seen some pretty genuinely improving earnings backdrop for value-related companies. So analysts expect about 10.5% earnings growth coming from value this year. This is up from just about 1.5% earnings growth back in 2024. So there is a pretty an improving backdrop, and we very much believe that this rotation has some legs to it.
Interesting. With that in mind, then, where does that leave technology stocks? Like, are we not going to see a rebound? I imagine a lot of investors are still holding a lot of technology stocks. Or are we just going to see them kind of continue on the trend they're already on?
It's been really interesting. It seems like the market is sell first, ask questions later, right? So, I think there could very well still be a little bit more pain. It's noteworthy that when you look at, obviously a very big player in our index, the largest company in the world, just reported another fantastic round of results, yet you're not necessarily seeing the stock price rally quite meaningfully off of the back of that. So, I think, again, there's just a lot of this AI fatigue. And the problem is, particularly with a market cap index like the S&P 500, if these big names in the index necessarily don't perform well, it's sort of hard to have the index perform well at the surface level, just given that concentration risk. So, look, we're not dumping these companies altogether. They're strong balance sheets. They've got the cash flow. They're spending, actually increasing their capex really across the board. But we do recognize that the market is growing a bit weary and is looking for some proof in the pudding across tech.
No kidding. Okay, so we talked about that recent value rotation that we're seeing to, as you say, beginning in the fall of last year, continuing into 2026. How do you see that benefiting sectors in Canada this year in certain economies, like, for example, materials, energy, in certain sectors like that?
It is incredibly important. Obviously, the Canadian market being a very value-orientated market, you're getting a lot of financials, materials companies. The slope of the curve, right, is steeper out in Canada relative to the U.S. So you've got that net interest margin profitability coming through. Some of the challenges, though, of course, is the consumer and sort of the pace of overall economic activity. We do anticipate that U.S. growth could run a bit stronger than that of Canadian growth. And so as you think about consumer activity and lending activity and credit growth and credit creation, that could be a little bit of a headwind towards financials more broadly. But that being said, right, when we think about this new AI build out, this AI landscape, it is the energy companies that are going to be powering the data centers. It's the industrial companies that are going to be laying down the fiber optic cables. It's the material companies that are going to be providing the hardware inputs to all this build out. So again, we think this is a kind of a multi-year sort of trade. And what's quite interesting, or sort of the tagline that I've been running with is this growth spending is translating into value revenues. We're seeing that in the numbers.
Okay, so I want to talk about emerging markets, obviously, because that's part of this conversation. You think emerging markets poised for yet another strong year? Are there any interesting trends that you see happening as we head further into 2026?
Absolutely. So when we look at, and I like to break down the contributors to returns, so whether that be dividends, earnings, valuations, so multiples expanding. When you look at emerging market returns, this was a big story last year. Most of the returns were coming from earnings growth. This year, all of the roughly 15% return that we've seen on the MSCI Emerging Market Index is coming from earnings. And there's a number of different sort of regional aspects here. When you look at Asia, for an example, they're benefiting from this broader build out as being the primary providers of many of the chips and semiconductor inputs. Periphery Europe, for an example, is benefiting from perhaps the consumer coming back online, the technology wave as well. Also, sort of luxury goods and brands, that part of the market does appear to have some further upside from here. year. And then specifically with Latin America, while the earnings necessarily hasn't been quite as strong, the backdrop remains constructive, with this broader resource grab, energy grab, more broadly on a global scale. We're not calling for a commodity super cycle per se, but we do think that commodity prices could move higher. And the second derivative of that are going to be commodity exporters, which many of them are in Latin America. So, the backdrop remains pretty supportive for emerging markets, and investors are voting, are following that with dollars, and that's why we're seeing continued strong performance out of that area of the market.
So interesting. Okay, we will have to leave it there, but really appreciate your time and your insight. Thanks for joining us today.
Thank you.
That's Jordan Jackson, global market strategist at JP Morgan Asset Management. Up next, Netflix has withdrawn its bid for Warner Brothers. We'll find out why it could be a win for the streaming service right after the break. Netflix has dropped its bid for Warner Brothers, clearing the way for rival bidder Paramount to clinch its multi-billion-dollar deal for the historic Hollywood studio. To explain why this could actually be a win for Netflix, though, we spoke with Alicia Reese, Senior Vice President of Equity Research at Wedbush.
Netflix has already committed to $20 billion in content spend in 2026, whereas its prior commitment was $17 billion. It has $2.8 billion that it's getting from Paramount for breaking up the deal, and they have a lot of opportunity here because their competitors are going to be tied up in this regulatory scrutiny for the next several months, and they have a lot of content out there to go after. And yeah, I think that's going to be a win for consumers.
All right, let's talk a little bit about the deal that wasn't now. Why did Netflix pull out? Was it simply getting too expensive and not worth it?
Yeah, Netflix's primary commitment was to its shareholders, and the deal was a positive one. They were going to be able to leverage all of that amazing Warner Brothers content against their new ad stack and grow that meaningfully globally. There was a huge opportunity with theatrical in opening that market, but the pushback they were getting from Hollywood was becoming quite cumbersome. The price tag was the ultimate deal breaker, though. They weren't about to overpay for it, and at this point, they were going to have to overpay. And they didn't let their egos get in the way. They were absolutely committed to their shareholders. And they saw, based on when, Paramount came in for the deal, that their shareholders were happy, that there was a possibility that they would not go through with the deal. And so they didn't, they were committed. And I think that shows great restraint.
And what kind of a role did politics play on this? Was there any, do you think? I mean, there were all kinds of, there was a flurry of meetings.
More than you would like.
Yeah. Okay.
More than anyone would like, I think. Unfortunately, that's just a simple fact. The regulatory process could be lengthy anyway. And there were plenty of arguments against Netflix in the regulatory process anyway. With the market share arguments, it's a tough argument to make that YouTube is in the same market. There are some arguments for, many against. And I think that would have gotten hung up for quite a while. Ultimately, though, some of the friendships between Paramount and the White House might accelerate the regulatory process for better or for worse. I do think they'll still get hung up in regulatory over CBS and CNN potentially combining. They might have to create some remedies there. And then you have the CFIUS review that may or may not go through more seamlessly than it would have otherwise.
All right, and let's stay with Netflix. Where do they go now? We're talking about content. Is that what their focus is?
Their focus is on content and advertising. Those are the two main opportunities. They haven't gone big into live events yet, and they have a lot more opportunity to dive deeper into that. But they're really, really frugal with this. They're careful. They don't go and spend, lavishly on all these big sports properties. They're very, picky about what they choose, and what they have chosen so far has worked really well for them at great price tags. They also have this immense opportunity with advertising. They're in the very early innings of growing that, and they can double their advertising to $3 billion this year. That's just the very early stages, and they can, really expand that globally and leverage all of their content globally, their ad stack globally. There's just so much they can do. So with or without the deal, Netflix had a huge opportunity, and their share price recently hasn't reflected it. And we expect it to again soon.
I mean, I was just looking, I think they're up, doing the quick math, 10%, close to 10%,
yeah,
a little
10%
under right
today.
now. Yeah, 9.3. It was some quick math there. And with the live, I mean, what do you see them possibly going for with live? You said they're picky, but is there anything that they might have an eye on?
Yeah, I mean, they didn't go for the Men's World Cup, but they did for the Women's. They go for a couple NFL games here and there. There are certainly more NFL games they can go for. One-off events are great for them. Boxing is really great. They, went after UFC. The price tag ended up being too high, so they pulled back on that, similar to this deal. They're just going to go for the right kind of content that works for the price tag. What I think will be really beneficial for them is to take international sports outside the U.S., outside Canada, and really grow those to a large extent by leveraging that against their global audience. They've done that with a lot of Korean content, let's say, and they can certainly do that with sports. Let's have some Aussie rules football for a change.
It sounds like they kind of like, to a degree, cheap and cheerful. They want good bargains.
Yeah. And they're very profitable as a result.
I'm just going to bounce again back to Paramount with CNN, and what do we see happening with CNN with this? Could there be a merge, or could they be forced maybe to sell it off?
Yeah, they might be forced to sell it off. That might have to be a structural remedy that is forced upon them. I'm not sure in this particular environment, but with the scrutiny that was promised to Netflix, I would be surprised if there wasn't, at least some deep level of scrutiny against this one as well.
All right, and big picture, any other mergers on the horizon right now, or is this about what there is? Was this the opportunity?
Well, yeah, I mean, Warner Brothers was distressed just because, they had some amazing content out this year. Pam Abdi and Mike DeLuca have done a phenomenal job on the theatrical and, content buying side. People are watching their content and loving it. So I think they're really healthy on that side, but they just had a lot of debt that they're still trying to work through and trying to, cut their way to prosperity, which is tough in this business. You have a lot of other studios that could potentially be up for sale. Sony may eventually, get rid of their studio arm. You have some smaller studios. You have Lionsgate still up for grabs potentially, and then you have smaller studios like A24 that are really seeing a heyday, putting out tons of good content. And
if you were a betting woman, any of them that you'd pick? I'm gonna put you on the spot for a sec.
I mean, if I was Netflix, I'd go after A24 personally.
That was Alicia Reese, Senior Vice President of Equity Research at Wedbush. Okay, we're going to take one last look at the markets before the closing bells. We'll start with the TSX, which has been reaching record highs over the last couple of days. Today, probably not, down still above 34,000, but definitely lower than what it finished at yesterday. And U.S. markets also falling today, basically on concerns around geopolitical concerns, as well as issues related to private credit. So a lot of investors feeling a little concerned as we end the week. You can see the S&P 500, Dow Jones, and NASDAQ all trading down at the moment. Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells at the NASDAQ. Kalisa Acquisition Corporation is ringing the closing bell today at the New York Stock Exchange. It is Quantum Emotion Corporation. And at the TSX, PDAC 2026 is closing the market. You are watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Street. All right, let's start with the markets. TSX ending the day down by 0.4%, not hitting the record highs it's been hitting over the last couple of days. S&P 500 also down by 0.4%, and the NASDAQ down by almost a full percentage point to end the day, as investors are a little wary about those technology stocks this week. If we take a look at some of the big moves of the day, Quebecor, one of the top performers on the TSX today, after reporting strong fourth quarter earnings this week that beat estimates. Shares have advanced the most in 2 years, and they're finishing the day up almost 5%. Aritzia, meanwhile, was the biggest lagger on the TSX today, with shares slumping the most since April. And this actually comes after a 3-session win streak for the company, but finishing the day today down by 7.8%. Another one we're watching is Atkins Realis. Shares hitting December level lows, falling as much as 9% this morning after a cash forecast miss. You can see regaining some of that throughout the day, but still finishing the day down by 1.6%. We're going to be talking about that in just a moment. Elsewhere, though, Dell Technologies was one of the top performers on the S&P 500 this morning after surging 20% this morning, but you can see finish the day up by almost 22%. This comes after the company gave a sales outlook for its AI servers that exceeded expectations. Dell says it will generate $50 billion in AI server revenue in the current fiscal year. We're also watching shares of Nike today. Shares dropped by quite a bit this morning after its Chinese supplier warned of a 57% year-over-year profit decline due to subdued consumer confidence and an oversupply of inventory in mainland China. And investors worry about that, finishing the day down by 2.7%. So for more on what moved the Canadian markets today, we're joined now by Bloomberg's equities reporter, Stephanie Hughes. Stephanie, good to see you. So we just mentioned Atkins Realis under some pressure today. What is it that investors are really disliking about their earnings?
Hey, Lindsay, happy Friday. So Atkins Realis, it really comes down to an earnings story. That's been the theme for a lot of Canadian movers this week. But those shares fell by over 9% at their lowest point, dragging that stock price down to its lowest level since December. And like you pointed out, it did end up recovering a lot of those losses throughout the trading day, but still ending the day in the red. And a lot of that has to do, the engineering firm reported it has to do with its earnings before income and interest, taxes, and other variables. That fell short of what analysts were expecting. And analysts say that that's caused by a heavier loss in what's called the lump sum turnkey project loss. So in layman's terms, it's a fixed price agreement that a contractor has with a client where they take on the costs of engineering, procurement, construction throughout the entirety of the project and are basically on the hook for it. So that's basically what happened with Atkins Realis. Maybe there were some project cost overruns that they had to account for. They also forecast a lower net cash from operating activities rate throughout the year, expecting in 2026 for that to come out to $500 million. That fell short of what analysts were expecting as well. But a few analysts weighed in on the results, and they were kind of fairly neutral on the results that we saw today. But one note that stood out to me was National Bank Maxim Saichev, the analyst. He said that, sure, there are puts and takes on the results today, but any dip here he would see as a buying opportunity. And that's because he agrees that, or he argues that the net asset value exposure to the nuclear segment is what is making Atkins Realis a really safe bet in the engineering space. So some analysts, despite the miss today, see Atkins Realis having at least a little bit of a glow to it, Lindsay.
And then you're also watching shares of Laurentian Bank. Is it the same story there? Like investors just not impressed with this earnings?
It's a bit of a mixed picture for Laurentian Bank, and for this company in particular, it is ending a week of Canadian bank earnings on more of a whimper. Laurentian Bank's adjusted earnings fell slightly short of what analysts were expecting. Shares didn't really move all that much, but the miss seems to be tied to higher expenses related to salary and technology costs. That said, it was probably the only Canadian bank today that was really holding its own, spending most of the day in the green. Just based on this broader financial sell-off. And a lot of analysts attributed that to the pending asset sale to National Bank and Fairstone that's expected to go through soon. So there's a broader sell-off, like I mentioned, happening in Canadian and U.S. banks. It's just a broad-based sell-off based on angst around AI and credit risks. But for Laurentian, despite the miss, analysts, for the most part, say it's a pretty neutral quarter, so they're not punishing it too hard today. And it's actually still ended the day in the green, even though all the other major banks are slipping today. Lindsay.
Yeah, interesting chart there, too, over the past year. Okay, Bloomberg's Stephanie Hughes joining us. Yeah. Thanks so much, as always, Stephanie. Up next, U.S. markets declined today after a hotter-than-expected PPI report reduced investor expectations for easing inflation and additional rate cuts. Here's how things ended today. We'll be back in a moment with more. Welcome back. We're going to dive into today's market pullback. And to do that, we're joined by Kim Forrest, founder and chief investment officer at Boca Capital Partners. It's good to have you join us. Thanks so much.
Great to be here on a Friday.
Yes, thanks for joining us on a Friday afternoon. I mean, it's interesting because OpenAI announcing this deal today of funding supported by some big companies, right? You've got Amazon, NVIDIA, SoftBank. Markets are down, though. Like, are investors just not as excited about funding announcements like this anymore, do you think?
Well, I hate to point this out. I'm master of the obvious. I think that's my gifting here. These are more circular deals. And I think people are really concerned about these companies, although they make a lot of money and have access to a lot of money, they just keep piling it in this circle, right? So Amazon, who provides web services to OpenAI, among others, is funding OpenAI. And, you know, I'm very practical. I see all this money going in here. I enjoy using AI. I don't trust it because it's not correct enough for me to trust it. However, what I really don't trust is that people are ever going to pay the huge sums of money that has been needed to develop it and to continue to develop it. So a lot of stuff has to change for me to get wildly excited about large language models in particular. Other forms of AI, I'm all about it. Smaller problem-solving AI, awesome. But this big, spectacular, you know, AGI sort of AI is scary from a financial perspective. And I think that's what today's market shows you, that other people are like me, not convinced that the financial case for it makes sense at this point.
Interesting. Also today, private credit stocks taking a hit lately, really, not just today. Do you think Jamie Dimon was onto something when he warned of cockroaches in the financial system?
Well, if you roll the tape back, he pretty much has talked about cockroaches all the time, right? He always has that glass half empty. Wonder if he started as a bond manager, maybe. That's always my joke. You know, the equity people are half glass full, bond people half glass empty. But he is right in this. And I think, you know, I've always been cautious about recommending private anything, but specifically private credit for a lot of reasons. Companies, theoretically, a private credit companies should be able to return higher shareholder value because they don't have the structure of a bank, but they also don't have the structure of a bank to keep them from going out on the risk curve. And I think that's really what we're afraid of here and what is causing the sell-off across all financials, because rightly so, and I'm sure Jamie Dimon would agree with this, the financial sector is all linked together.
Mm-hmm. It's so interesting, too. I mean, I want to go back to what you were saying before, you know, about the big tech companies and all this spending that they've got going on right now. Like, a lot of them are saying, a lot of these hyperscalers, that they're going to continue with their AI capex. But how likely is that if people are worried about this aggressive spending and the stock is dropping, how can these companies continue to move forward with that spending?
Well, the Magnificent Seven are money-making machines at this point, right? Or we'll say the Magnificent Four of the Magnificent Seven. That's Microsoft, Meta, Amazon, and to a lesser extent, Apple. But they all have a lot of money that they can pour into this project. And as long as they're pouring into the project, there will be other companies like private equity and venture capital funds that are willing to spend in this new area. They always have been risk takers, so they're going to, you know, take risks and continue to fund. But you know, I'm practical to a fault. I just don't see the return for investors in this in any kind of short way, given the billions of dollars that have been spent and hundreds of billions of dollars that are promised to be spent in the future. Who's paying the bill? Mm-hmm. I don't see it.
Also, NVIDIA shares dropping again today. They're down to end the day almost 5%, 4.2%. This ever since they reported those earnings on Wednesday, right? That seemed strong, but had negative results on the stock market. What do you make of that, of investors, you know, being a little worried about those results? And also, do you see this as a potential buying opportunity?
Sure. Well, I think the investors are kind of running the scenario that we're talking about right now through their heads and going, well, I've made a lot of money, maybe time to take it off the table. The other thing is, NVIDIA has been a momentum darling. If you are a momentum investor, 2023, 2024, and 2025, about halfway through 2025, it was a wonderful time to own it, but it's gone nowhere. So this is kind of a death spiral that a lot of momentum companies go through whenever they stop growing. It's a great company, but it's not for momentum investors anymore because they're not putting up those ridiculous numbers that they have in growth. Mm-hmm. So, it takes a while for a once momentum stock to find its place in the world. And that's, I think, what we're seeing here at the beginning of NVIDIA selling off is momentum. It's not a stock for them.
Will be interesting to watch this unfold. Okay, Kim Forrest, founder and chief investment officer at Boca Capital Partners. Appreciate your time. Thanks so much.
Thank you.
Up next, Chartwell retirement residents reported their fourth quarter earnings, and we uncovered developing projects for 2026 and more with the CEO. Stay tuned. Chartwell Retirement Residences reported their fourth quarter earnings. And for more, we were joined earlier by Vlad Volodarsky, CEO of Chartwell Retirement Residences.
Our occupancy increased by 480 basis points during the year, reaching 95.2% in our same property portfolio in December.
And let's put up a 5-year chart for your stock, because I was just looking. The low point, I guess, for occupancy was in 2021. If we put up, there's a 5-year chart. You got down to, below 80% at one point.
It was nearly 76%, yes.
Right. And wow. So the business is booming. I guess you got demographics on your side.
Absolutely. We do. Clearly, post-COVID recovery has been thankfully robust. We do have environment that's never been as attractive as it is today to be in senior housing, where the demand is growing by between 4 and 5% annually. And we had now 4 or almost 5 years of very little new construction starts. And so we have this dynamic of growing demand where there is virtually no new supply coming in.
I think we've talked about that before, the enormous cost of construction in Canada right now.
Yes, and things are improving, both on the cost of construction side and clearly with the successes that all operators have in this environment. We think that there's going to be some construction starts in 2026. We already have 2 projects in construction in Quebec and 1 in development in Alberta with our partners. And we think we're going to start a few more in 2026. Clearly, there is need for more suites to be added.
So I was just looking here, your revenue per occupied suite up 4% to just over $5,000 in 26. So that's an average. It varies, though, across the country.
It varies across the country. It varies across different service levels. Our portfolio is anywhere from independent living to assisted living and memory care. So people who require less services pay lower prices, and people who take up more services pay higher prices. Generally, in Quebec, rates are lower because the model is more of an a la carte, where people, when they join us, they pay just rent, and meals are not included. They might have monthly housekeeping included in that rent. And then as their need progress, they can add on meals or care services on an a la carte basis. In the rest of the country, the model is more of an all-inclusive, where meals usually and some of the support services would be included in the base rent and services price.
So if you can generalize, a single person could get a suite with all meals for $5,000 a month?
With meals, yes.
With meals. $60,000 a year. Yeah, but the cost of living these days, everything is expensive these days. And I'm just if a couple moves in, they're not paying twice that, though.
They're not. They're paying for the services that the second person's consumed. And when people talk about $60,000, it does sound like a large amount of money. There's also cost of living at home that people don't often realize exist. Where often our customer has mortgages paid off, and they perceive that living in their home is virtually free, which is not true, of course.
Taxes, repairs, you name it.
Meals.
Yeah, meals. I know. Yeah, yeah. Oh, I like the idea of having everything done for me, I must say. What is the typical age that people come in? Can you, or what is the sweet spot that you start really getting people?
It's about 80 years old, low 80s.
That old. That's interesting. People generally hang on in their houses through their 70s.
Generally, yes. And nowadays, people are healthier and living longer. And so it's understandable that by the time they make decision that they need some support or they do not want to keep maintaining their residence, at that point in time, usually people make decisions to move.
I'm ready to stop maintaining my residence now, especially with this winter and shoveling all that snow.
I'll leave you my business card.
Okay. First time you've increased the distribution since 2019.
That's correct. We started distribution increases back in 2014 when we felt that we have solid financial footing and the business was progressing very well, and we maintained modest distribution increase pace from 2014 until 2020, when, of course, pandemic happened. And we made what was a difficult choice at that time to maintain the current level of distributions all the way through pandemic. And now we feel that we're in the position that we can start, again, distribution increases, and our intent is to continue to do this on an annual basis as our earnings continue to grow.
Your debt to EBITDA, it looks high at around 6.9 times. Can you put some color on that?
Not in the real estate context. So in the Canadian real estate context, 6.9 debt to EBITDA ratio would be on the lower end across all the REIT universe. So generally, on average, it'll be probably close to 9, and we're now at 6.9. Our target is to maintain net debt to EBITDA under 7.5 times.
What is your credit rating? Is it investment grade?
It's a BBB low, with positive outlook, so hopefully with some hope of upgrade.
Yeah. And what is your plan now on the distribution? Do you hope to increase it every year, or?
Absolutely. The intent is to continue modest distribution increases and sharing the growth in the cash flow with our unit holders. We also balance it against the opportunities to deploy capital within our business to acquire newer, higher quality properties and towards our development activities.
So places come up for sale. You don't always have to build them yourself.
Yeah, we've been very successful in the last several years. Just in 2025, we closed or announced $1.7 billion worth of acquisitions of higher new properties, and we expect to continue to do that going forward.
That was Vlad Volodarsky, CEO of Chartwell Retirement Residences. Coming up, Citi is out with a new report on the importance of the U.S.-Mexico-Canada trade agreement, and we will break that down for you right after the break. Prime Minister Mark Carney landed in Mumbai this morning for the first stop on his 10-day trip to strengthen trade ties and diplomatic relations. For more on what's on the agenda, we were joined by CTV's Jeremy Sharon.
Lindsay, this is a significant trade mission for the Prime Minister. He makes his first stop in India, but then will also travel to Australia and Japan. There is much focus, though, on the first leg of this trip, the India portion. He starts in Mumbai, where he'll spend a few days, then make his way to New Delhi. That's where he'll meet with Prime Minister Narendra Modi. But the focus here really is on bolstering a trade relationship with what is a massive South Asian economy. Both India and Canada are looking to reduce reliance on the U.S. and diversify trade partners. What we do know is it is expected several MOUs will be signed on things like energy, defense, critical minerals. We also know that several themes will be part of discussions, including education, tech, crime, and immigration. This is all part of what the federal government is working towards, which is an eventual more broad-ranging trade deal with India. It's not expected that will be finalized during this trip, but some of that groundwork will be kind of laid out, and the start of negotiations on where both sides feel they can collaborate will begin. Energy is certainly an interesting one. India is facing pressure to reduce its energy reliance on Russia. It gets a lot of oil from Russia. Canada, of course, is a big exporter of crude oil, and so there's a natural connection there, a path to be able to do business between the two sides. But nonetheless, this is a significant trip, and the Prime Minister and his team will be focused on bolstering trade relations with, again, what is a South Asian economy that is absolutely massive. All of that being said, there are significant challenges during this trip, and that is due to allegations that have been made against the Indian government. We look back to 2023 and the killing of BC Sikh activist Hardeep Singh Nijjar, which the RCMP linked to the Indian government. We also have heard as recently as last year definitively from CSIS that India is one of the main perpetrators of foreign interference and espionage. We heard as recently as last Sunday that the RCMP had warned a BC Sikh activist that there was a credible threat on his life. Despite all of that, a senior government official in a tech briefing with reporters ahead of this trip made it known that the Prime Minister probably wouldn't be taking this trip if the federal government believed that the Indian government was still actively interfering in the Canadian democratic process. So that is a departure, a significant departure from the position the government has taken on potential threats that India poses when it comes to those types of things. And Sikh activists in the Sikh community here in Canada is speaking out about this, pushing back against those claims that India is no longer involved in these kinds of activities, pressuring the Prime Minister to take a stronger stance and to definitively say whether or not that senior government official was speaking on behalf of the government and whether that is actually the stance of the government. So the Prime Minister is likely to face some pressure on that front during this trip and will likely have to answer as to whether or not that is officially where the federal government stands on this. Lindsay.
Okay, thanks for that. That was Jeremy Sharon from CTV News. Citi has released a report on the economic backdrop leading to the U.S., Canada, Mexico trade talks. The three sides are expected to return to the bargaining table this July. We spoke earlier with one of the authors of the report, Sarah English, Managing Director of Global Governmental Affairs at Citi.
Our report, what we just published a couple of weeks ago, I think really highlights the benefits of the agreement as a trilateral agreement. And I'll just highlight two key numbers for you. Mm-hmm. The first one is the growth in trilateral trade since the agreement's inception has grown to $1.9 trillion. That's a $400 billion increase in just, according to our numbers, in 4 years. That's a really big number. The second thing is the boost that it's gone to jobs and creating regional supply chains. And according to our facts, Canada is now the third largest investor in the United States for foreign direct investment and the largest job creator in the last 4 years. So the agreement really has strengthened regional trade and brought lots of benefits across the borders.
Can you did you manage to quantify, and I know it's very complicated, did any particular country do best out of the deal over that period?
I mean, I think when we looked at the report, according to our data, it shows a lot of benefit to the United States with having the regional strength of the trade agreement. But also, if you think about it, it's an update to the NAFTA agreement. So we're talking about 30 years of partnership. Mm-hmm. And companies across the borders have built these supply chains. And the updated version, which is the USMCA, has only strengthened that supply chain. So the benefits are actually spread across all three nations.
Can you talk at all about, say, Mr. Trump's setback at the Supreme Court? Is that likely to affect the renegotiation of the deal? I know that's not really part of this piece of work.
It's not. And if you look back to the beginning last year in Liberation Day, USMCA goods and imports had been excluded from those tariffs. So I think, and they continue to be when they issued the new executive order using a different authority, USMCA continues to be excluded. So I think that says a lot in terms of the strength of the agreement and the importance of the agreement.
I mean, I know it's a fraught question, but do you think major change, if and when it's renegotiated between the three countries, if we do get a trilateral deal, are there any major changes you think will be made?
I think, in our report, we point out that there's likely to be a bumpy renewal, and I think that's probably the right category to put it in. I think there are certain things that need to be updated, perhaps around economic security. These are things that have been in the press. And these are to really strengthen supply chains that have been established already. And I think there might be some other updates, perhaps on the digital front, maybe even critical minerals. That's a huge opportunity now for all three countries.
You gave us the main findings. Do you think there's anything about the trade agreement that people don't realize, or that politicians maybe should acknowledge more, or that the public have missed out?
It's a great question. I think, if you go to, individual states or individual provinces, you'll see just how integrated the trade is. When we talk to our clients, not just in Canada, Mexico, and the US, but we're talking to global clients that are looking at North America and our regional supply chains here as an opportunity for them to invest. So I think that's something that perhaps is not as easily done in the data, but if you talk to companies, if you talk to small businesses, you can hear that benefit.
That's interesting if you get out there on the ground, because, of course, the U.S. economy is so vast that any overall number is going to be a bit misleading. And it's funny, really, USA is in a way a continent, isn't it? In a way, the Great Lakes economy is very closely integrated with Ontario, for example.
Absolutely. And if you look across the Canadian border, and if you look across the Mexican border in the United States, those economies are so closely tied, and all the production has moved to those border states to help facilitate that trade even more efficiently.
That was Sarah English, Managing Director of Global Governmental Affairs at Citi. Okay, we've got a couple pieces of breaking news to tell you about, starting with some breaking news coming out of the White House. President Donald Trump has directed U.S. government agencies to stop using Anthropic PBC's products, capping a feud between the artificial intelligence giant and the Pentagon over safeguards on its technology. Trump said today that there would be a 6-month phase-out period for agencies that are using Anthropic's products, including the Defense Department. And the move will almost certainly provoke some blowback from Silicon Valley. So we'll be watching for that. Also, Bloomberg is reporting that SpaceX is weighing a confidential initial public offering and targeting for as soon as next month. This is according to people familiar with the matter. SpaceX expects to submit its draft IPO registration to the U.S. SEC in March, and this would put them on track for a June listing. And one last thing to tell you about, this is breaking news. It is official. After a bidding war, Paramount will buy Warner Brothers Discovery for $31 a share. The transaction values Warner Brothers Discovery at enterprise value of $110 billion, rather. It has been unanimously approved by the boards of both companies, and that deal is expected to close in the third quarter of 2026. So we know now the final ending to that. Coming up, we will zero in on 3 plays in basic materials right after this. Stay with us. It's time for Hot Picks in Basic Materials. We were joined earlier by Seth Goldstein, Senior Equity Analyst at Morningstar.
Corteva is one of the leading patented seed and crop protection chemical companies in the world. And so these are the essential products that farmers need to grow crops and protect crops from insects, weeds, and fungus pests. And so Corteva's leading portfolio of intellectual property really creates value for farmers because it allows farmers to grow higher yields with their crops. And many farmers turn to Corteva for their seeds and chemicals. Even when crop prices are low, they still pay up for Corteva's products.
And why are they spinning off the seeds business?
Well, they see 2 divergent growth paths for the seeds and the crop protection business, and they want to allow each to be fully funded and grow independently of one another versus having to, say, in the crop protection business, develop products exclusively for the seeds business. Now the crop protection business can focus on developing the products it thinks will be the best value for farmers. And so they see a good spinoff right now. Corteva has a very strong balance sheet, net cash position, and really this is going to be 2 leading companies instead of one, both a seeds leader and a crop protection leader post spinoff.
The stock has been doing well. Is it a cyclical name in the sense that it rises and falls with crop prices?
Not as much. For agriculture, it's very cyclical based on crop prices, but for Corteva, they're a little less cyclical versus other ag companies because the seeds business tends to do well based on Corteva's new seed development and how they do versus rivals such as Bayer versus just rising or falling with general crop prices.
Mosaic, a giant fertilizer company, huge phosphate franchise. They're in the other crop nutrients, though, as well. Why do you like the look of this one?
Well, Mosaic has had some company-specific issues at both its potash and phosphate mines over the past year, and this has really led to higher unit production costs. We have seen phosphate prices fall slightly for the start of the year, but we expect prices will stabilize in the low $600 per metric ton range. We think potash prices will remain in the mid $350 per metric ton range, and longer term, as Mosaic produces more potash from its low-cost Esterhazy mine, and as Mosaic is restoring its phosphate production, we expect unit production costs will fall and profits will grow, generating positive free cash flow for Mosaic, whereas the current results don't reflect where we think they can get to under mid-cycle conditions.
Sorry, just remind us, what problems have they had over the past couple of years?
Yeah, they've really had some long-term mine issues, both their phosphate mines in Florida and their Canadian potash mines, and they've really had some challenging production issues. They've been trying to ramp up these productions. In Florida, they've also had some storm damage impact some of their mines in recent years, and so really they've had to spend a lot of extra costs over the past year and into this year to really make sure that the long-term health of these mines is set up so that they can ramp up production. And in the meantime, this has created some higher near-term costs. And I think the market's extrapolating this to assume it goes on longer than we think it will.
Eastman Chemical, now they were affected by the U.S. Supreme Court decision against some of President Trump's tariffs. Tell us how that played out.
Yeah, so President Trump, after the U.S. Supreme Court came out and said the tariffs were illegal and unconstitutional, President Trump said the tariffs will go ahead. And this really hurt Eastman and all chemical stocks because for Eastman, they sell a lot of specialty chemicals to companies that make consumer products that are then exported to the U.S. And so there's really big secondary demand impact and secondary impact of the tariffs from Eastman due to lower demand from their customers. And really what we've seen is this has caused chemicals, which is already seeing bottom of the cycle type of demand. The bottom of the cycle conditions just continue and will continue into 2026. But the good news for Eastman is they have a good balance sheet. They generated free cash flow last year exceeding dividends, so we don't see the dividend as at risk like some of their chemicals peers that have had to cut their dividend. And Eastman is well positioned for a recovery. So when we see the eventual demand recovery, we think Eastman will see profits snap back in quickly short order because their specialty materials are essential to their customers and just tend to work better than their customers, which gives them very strong pricing power.
And what about the dividend? Is that one reason why investors buy this stock?
It is. Right now, you get a really high dividend yield, and you don't have to worry about it being in jeopardy versus, Dow, Lyondell, Celanese have all had to cut their dividends over the past year due to not generating enough positive free cash flow or high debt levels. Eastman has a better balance sheet. Eastman generated free cash flow above dividends. And so we see the dividend as very safe, and essentially investors can collect the dividend and wait for the chemical cycle to recover.
That was Seth Goldstein, senior equity analyst at Morningstar. Up next, a Supreme Court block shakes up trade. That story behind the shift next. The Supreme Court's decision blocking Donald Trump's tariff strategy has thrown U.S. trade policy into turmoil. Bloomberg Originals looks at what his trade war has actually accomplished.
For President Donald Trump, few things appear to matter more than
tariffs. Tariffs. Reciprocal tariffs. A lot of tariffs. The most beautiful word in the dictionary is tariff.
Now his signature policy has hit a roadblock.
Trump's biggest legal defeat since returning to the White House.
The Supreme Court striking down President Trump's tariffs.
It's a major blow to President Trump's economic agenda.
2/3 of the tariffs that President Trump implemented in 2025 have essentially been ruled illegal.
That really has taken away one of the main ways in which President Trump has disrupted the global economy.
But Trump says he isn't backing down.
Today, I will sign an order to impose a 10% global tariff under Section 122.
A day later, he upped the ante, saying he'll raise that rate to 15%. But these can only stay in place for a maximum of 150 days.
What he is going to have to do now, instead, is use tariff authorities that are much narrower and in which he really has to prove an economic case for the need for them.
For US trading partners around the world, it's causing tariff whiplash all over again.
The EU was the quickest to react so far. They have moved to freeze the implementation of their side of the trade deal that was signed with the US. There are a few countries that actually stand to lose despite facing lower tariffs now than before the ruling. So countries like Vietnam, what they've lost is the comparative advantage that they had relative to China. China is probably the biggest winner from this ruling.
Almost all countries and corporations want to keep the deal that they already made.
So, how will this affect businesses and consumers, or the trajectory of Trump's remaining 3 years? And what happens when the 150 days are over?
We have maximum uncertainty over where trade policy goes from here.
This wasn't a battle before the Supreme Court between President Trump and China or a faceless corporation. The main plaintiffs who challenged these tariffs were a toy company, Learning Resources, and a whole coalition of other small businesses who really felt like President Trump and his tariffs were an existential threat to their businesses.
At the centre of the fight was a law called the International Emergency Economic Powers Act, IEEPA. It allows a president to regulate some aspects of commerce after declaring a national emergency.
Trump claimed that it gave him the power to immediately put a tariff of any level on goods from anywhere. And the Supreme Court ruled that just wasn't the case.
What the court didn't make clear is what happens to the money already collected.
Essentially, the Supreme Court ruled that the U.S. collected $170 billion in tariffs unconstitutionally.
Trump himself has indicated that this is going to take years of litigation to calculate and distribute refunds.
There is the possibility that it could just be a very clean process. The Customs and Border Protection knows who paid the tariffs and knows how to refund them.
There have been episodes where tariffs have been refunded in the past. That's not unprecedented, that's not unheard of. But the scale of this, I think, is unprecedented.
Think of it as the mother of all tax refunds.
Trump had promised that foreign countries would be the ones paying for his tariffs. But
as it turns out, the foreign exporters aren't eating the tariffs. They're 90-95% passed through to US importers and their customers.
Reducing the US trade deficit was one of Trump's stated goals with tariffs, but in truth, they've barely moved the needle.
The United States last year in 2025 had a trade deficit in goods of around $1.2 trillion. It was almost exactly the same size as the trade deficit that it had in 2024.
The main impact we saw from the tariffs was to reshuffle trade away from China and towards Mexico and other Asian countries, more than reducing the aggregate trade deficit.
And so far, Trump's trade policies have failed to deliver on another long-held promise: rekindling US manufacturing.
Trade policies will return significant manufacturing jobs to our country.
The problem so far for President Trump is that 10 years on, the situation in manufacturing doesn't look that much better. In fact, in the last year, the U.S. lost more than 80,000 manufacturing jobs. That's even as these tariffs went into place. A lot of manufacturers rely on imported components, and if those imported components and big things that they use like steel and aluminum are more expensive as a result of tariffs, they can't hire more people. They can't grow. The costs are just higher.
More tellingly, if we separate that industrial production into industries that faced higher than average tariffs and lower than average tariffs, we see that any growth that was there was really driven by the lower tariffed industries, things like pharmaceuticals, electronics. Whereas the higher tariffed industries, think autos and metal sectors, faced much slower production growth.
Manufacturing is no longer going to be a big source of employment. The jobs that have gone, most of those jobs are not coming back. The principal driver of that trend is not trade, it's technology.
But it's Trump's foreign policy, not domestic, that now may need to change the most.
The biggest blow to Trump from this Supreme Court decision is really how it hits his ability to shape geopolitics in the world. He's used tariffs to threaten India and its purchase of Russian oil.
They will not be buying oil from Russia.
He's used the threat of tariffs to also interfere in domestic politics, like in Brazil. Those are all things he was able to do because of this authority he claimed that gave him this kind of immediate ability to increase his leverage, to apply pressure on other countries.
But that may have backfired.
I don't think there's anything wrong by any means with an American president seeking American advantage. That's the job. The question is, are these methods working? So if you think of Europe, if you think of Canada in particular, governments are weak in many ways in relation to the US. The demands that the US is making are so off the charts in terms of their previous experience. I think they're struggling to process it. You know, can we rely on the US commitment in NATO? And the controversy that followed the president's demands about Greenland.
We want a piece of ice for world protection.
There were Europeans who were actually wondering whether at some point European soldiers would be fighting US soldiers. Extraordinary.
All of this is happening in the run-up to the US midterm elections.
Poll after poll shows that these tariffs are incredibly unpopular and that people associate them with this broader issue of affordability. It's just another way that they see the government making life harder, raising prices.
Republicans should be asking themselves if they want to keep backing this policy, which is just meeting obstacle after obstacle when it comes to implementation.
Trump wants Republicans to win the midterm elections. It's going to be harder for them to do so if a lot of voters don't like his signature economic policy.
And it's something the Republican Party can't ignore, since Congress has to approve extending tariffs once these first 150 days are up. A budget reckoning is looming, exacerbated by the possibility of the government issuing tariff refunds.
One of the big issues going forward is going to be the fiscal implications. Huge sums of money are involved. And if that goes away because of refunds, then that's a new hole in the budget deficit outlook.
One of the major policies implemented last year was the continuation of tax cuts and other expansionary fiscal policies that would otherwise raise the fiscal deficit, and the administration was really counting on this revenue from the tariffs to plug that fiscal hole and finance the fiscal deficit.
But even with tariffs, the numbers don't add up. With the exception of the Clinton era, the US has been running deficits steadily. The pandemic required massive government spending, and the tariffs introduced since Trump's first term have made a dent. But the trend is the same, with the annual deficit still hovering near $2 trillion.
The public debt was on track to keep increasing in relation to the size of the economy. If you take the tariffs away, that fiscal gap gets very much bigger. very much bigger. Then the question becomes, is the bond market going to be okay with that?
The bigger worry is this growing sense of unease about the United States, and that erodes over time the power of the dollar as the world's great reserve currency. And that essentially investors around the world slowly lose confidence in the United States.
That loss of confidence is being fueled by Trump's disdain for some of the institutions behind America's perceived strength, like the Federal Reserve and now the Supreme Court.
This isn't the last time the Supreme Court is going to weigh in on President Trump's use of presidential powers or his invocation of emergency powers. This is the beginning of a broader potential conflict that has enormous ramifications for the United States, its governance, the state of democracy, and the Constitution.
And that does it for today's program. Thanks so much for joining us today. Have a great weekend.